Welcome to our continuing series on the Kenya income tax reform. This particular session is devoted to the capital gains, reforms of the capital gains tax. With me in this session is Osborne Wanyoike, who is a director in the PwC Kenya tax team. Welcome, Osborne.
Yeah, thank you, Titus.
Okay, so CGT was reintroduced after being suspended for 30 years. Maybe let's just give us a short background. Why was it suspended? Why was it introduced? And what impact is it having so far on revenue collection?
Okay. Thank you for having me. Yes, you're right. The capital gains tax was suspended in 1985. At that time, I think the government felt that the tax was not performing as it should. In other words, there were a lot of administrative headaches, challenges in terms of just knowing what to pay, how much to pay, who to get the approvals from. And therefore, the government must have felt that the tax is causing more disruptions to business than actually adding to tax revenue. So after suspension, after 30 years, the government then said, okay, we are the only country in the region that doesn't have capital gains tax, and therefore there was some pressure to reintroduce it. And in 2005, 2015, they introduced the tax back. Now, after the introduction, there was obviously some challenges in terms of people were not aware of the tax. And in fact, one of the things that happened is that the stock exchange actually felt the impact in terms of the number of shares traded on the stock exchange actually reduced because of the impact of that. But that did not stop the government from embarking on the tax. And in terms of your question on the impact on revenue collection, yes, it has gone up because it's starting from zero. So in the latest statistics, it says that it has grown by 86% for the 6 months ended 2017, December. But that doesn't tell you the whole story in terms of compliance. As you may be aware, there are a few cases in the High Court challenging certain aspects of capital gains. But generally, the tax is in place. I think all the hurdles that were there have been ironed out, and I think the tax is still going to perform much better, but obviously at the rate of 5%.
Yeah, maybe just touching on the rate 5%. That appears to be lower than the capital gains tax rate in the rest of the region. Maybe you could explain to us why the rate is lower in Kenya.
Okay. The rate of 5%, in fact, yes, it's the lowest. Tanzania and Uganda are at a higher rate of 30%. But the rate of 5% has twofold impact. It is a low rate relative to a 30% rate. Therefore, that should encourage compliance in terms of 5% is obviously not a significant amount like 30%. So the government must have said, let's go in and introduce a low rate so that people think it's not such a big tax. It's palatable, if I was to use that word. Secondly, the rate of 5% takes into account the concept called indexing. So what happens in capital gains? Capital gains is the difference between the consideration that you receive when you sell a capital asset. In this case, capital asset is either land, buildings, or shares. What you receive less what you actually paid for it, which is called the adjusted cost. If you make a gain, you pay 5%. So if you have a piece of land that you keep for maybe even 15 years, the cost has been kept constant for the 15 years. Therefore, your gain will be so much larger. So indexing tries to eliminate or introduce the element of inflation on adjusted cost. But what the government must have thought to themselves, instead of going through the whole headache about indexation, let's just do a low rate of 5% for two reasons. Don't do any indexing, and don't allow people to do indexing, and also ensure that people comply with the laws.
And they also, looking at the legislation, they also introduced a whole host of exceptions or exemptions to capital gains tax. Maybe you could give us just a broad overview of what some of those exemptions are.
Unlike most taxes, there are always exemptions or exclusions. Capital gains is one such tax in terms of exemptions. Typical exemptions are to do with shares that are traded on the Nairobi Securities Exchange. Any gain that is made from that comes without any element of capital gains. You may ask why. We believe that that is a good way of promoting liquidity on the Nairobi Stock Exchange or Securities Exchange. You may find that with the introduction of capital gains on a Securities Exchange, you find that people shy away from trading in the Securities Exchange, and that is not good for the country in terms of the development of capital markets. So that is one of the reasons why we believe that there is an exemption on traded shares. The other exemptions are with regard to private property for individuals. If you own your first house and you stay with it within certain conditions, 3 years and so on and so forth, and then you sell the house, that gain, however significant or not, you don't have to pay capital gains tax. That obviously is just to promote housing, and obviously housing is one of the basic needs of individuals. Yeah. There are also other exemptions, but may not be so significant. But there are also thresholds in terms of, for instance, if you have a transaction on land and the consideration is not more than 3 billion, you don't have to get into the whole aspect of capital gains tax. So there are exclusions and there are exemptions, and there are also some that are specific to sectors. In terms of the venture capital companies don't pay capital gains. But those are just in terms of highlight some of the things that you get exemptions and exclusions. Okay. There is one that would like to see implemented much more, and maybe we can talk about that later on.
No, actually, and I guess what you're talking about is around business reorganizations. Why is this such an important thing why is this such an important issue for businesses around business reorganization, and how do you think the reforms around taxation, capital gains tax on business reorganizations what direction do you think it should take?
Okay. One of the things that businesses go through, especially when they are growing, is acquiring other businesses. I mean, you can grow organically. Organically means you grow from year to year. One of the other ways of growing is buying off other companies or buying into other companies. So over the years, you find companies forming groups because they have common shareholders. Now, it reaches a time where the shareholders say, wait a bit, I need to reorganize my group. It is no longer efficient to have shareholding all over the place in different companies, different shareholding. You have board meetings that are all over the place. So reorganizations are aimed at straightening or rationalizing not only the operations but also the governance of groups of companies. So it is a reality of business. Now, what we've noticed in the Act, yes, there is an exemption where you have a reorganization or acquisition. There is no capital gains tax. But they've given that exemption such conditions that makes business ask, is it worth the exemption? And this is what happens, that when you do a reorganization and capital gains may arise or does arise, you need to write to the minister or the cabinet secretary in charge of national treasury and explain yourself in terms of why the capital gains should not be paid. And you have to establish that it is in the public interest why you're doing a capital or why you're doing a reorganization. Obviously, you can imagine the cabinet secretary, national treasury, is a busy man, and in terms of trying to assess each and every reorganization, whether it's in the public interest or not. And obviously, what we'd like to see is not take away the minister's authority or discretion, but put rules around that, such that it becomes certain that if I do a reorganization, I am certain to get the exemption. It is not total discretion or a discretion that you're not quite sure whether you'll get it or not. And as you know, with uncertainty, you take a lot of time to make decisions, get decisions made. So would like to see, a whole bunch of rules such that you can get the certainty on the exemption that you may get on capital reorganization.
Another hot topic on CGT is around indirect disposals of assets. And I know there has been a publication by the OECD looking at some of how taxation of indirect disposals should proceed. Touch on that and give us some sort of hints as to what aspects of that OECD statement can be adopted here in Kenya.
Okay. I was hoping you would not ask me that question because it's such a hot topic and it's quite an intricate topic, but I'll do my best in answering that. The OECD and the United Nations together put together a document which is premised on the fact that developing countries are seeing that people offshore are not paying their fair share when they dispose of assets located in the developing country. In other words, the offshore indirect transfer does not appear to be paying taxes, which local or people residents actually pay taxes on a similar transaction. So it's because of the lack of transparency in terms of who is paying who is getting the gain, how is the gain being calculated, who's going to pay the tax. The developing countries are not sure or do not know or cannot collect. Therefore, what has been happening around the world is that developing countries have been erratically, imposing taxes on in any way possible, such that they can get their fair share of taxes. Therefore, the OECD put together a draft document that kind of spells out certain principles that says, if you sell an immovable property in Kenya and you make a gain, you should pay capital gains, whether or not you're offshore or whether you're local. So that's a basic principle. So irrespective of whether you're doing it through intermediate holding companies or ultimate holding companies, you should pay the tax. It's very easy to say that, but obviously it is very difficult to calculate the impact of that gain in a transaction that is happening in another part of the world. So the document was trying to address the concerns of the developing countries, but also looking at the impact such transactions have on developing countries and also the people who are getting the gain and obviously moving trade. So the document is a valuable document, and I'm sure the Kenya government is looking into it because they too must be feeling that are there transactions happening in Kenya that are occurring outside Kenya, but they're not getting their fair share. So we see that in the income tax reform that we're speaking today, that the government should look at that particular aspect on immovable property, which is land and buildings, and ask ourselves, are we getting our fair share? And put in rules that are certain, bring certainty, no subjectivity, and therefore there is some fairness and transparency in those types of transactions.
And maybe finally, as a way to conclude, are there other aspects of capital gains tax, the legislation that we'll be looking to reform, or are there areas which are uncertain or require some sort of clarification?
The list is long, but I think the ones that come on top of mind is capital losses. I think today I've just talked about capital gains, but you can make a capital loss on one transaction. Mm-hmm. The law is unclear on what happens if you get into another transaction and you make a gain. Mm-hmm. Logically, you should offset, the loss from the new gain. Mm-hmm. The law is uncertain. The law is also uncertain on the tax point. Tax point is when does the tax become due and who should pay it. Mm-hmm. There are certain transactions it is unclear as to who should pay that, and therefore you find there's some discretion that happens within the revenue authorities. To me, those are the most significant in terms of capital gains. We look at the rate to remain the same, obviously, because then the whole issue about people doing structuring goes away. And therefore, what we'd like to see is some stability in terms of the capital gains remaining as it is in terms of the rate, but just improving on the rules around it, the procedures, making it certain, making it transparent.